Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, welcome to a special episode of What's Driving the Markets. My name is Ravi Singh. I'm the Chief Investment Strategist at Standard Chartered Bank India, and I'll be the host for this podcast. In today's episode, we discuss a key question in investors' mind: the recent weakness in Indian equities and what should investors do. In a sharp contrast to the past 3 years, Indian equities have trailed global peers since the fourth quarter of 2024, under pressure from continued foreign investor selling. From the respective peaks, the Nifty index is down nearly 13%, while broader markets capitulation has been sharper, with the Nifty Midcap index down 19%, while the Small Cap index is into bear market territory, commonly defined as a drop of 20% from the peak. To add to investors' concern, the INR has come under intense pressure from the stronger US dollar, fueling foreign investor outflows. To get a sense of what to do in the current markets, I am joined by my colleague Mr. Vinay Joseph, who heads the investment products and strategy at Standard Chartered Bank India. Hi Vinay, welcome to the podcast.
Hi Ravi, great to be back on the show, and a very warm welcome to all our listeners.
Just to get things going, Vinay, Indian markets have been under some pressure for the fifth straight month. What's driving this weakness?
Well, to put it into context, we are now in a correction zone, which is defined as 10% down, and the Nifty index is down 13%. Having said that, when we look at India's market fundamentals, the recent weakness is not completely unwarranted and has been driven by a confluence of factors. First, we have seen economic growth and corporate earnings delivery, especially from first quarter of this fiscal year 2025, being much slower compared to the pace of delivery which we saw for fiscal year 2024. Second, our valuations are at premium, both on absolute as well as relative to major peers. Third, as highlighted, we have seen very sharp foreign investor outflows from equities, close to nearly $23 billion since October 2024, very close to the peak of this cycle, which has dampened on risk sentiments and has offset actually the strong domestic investor flows, which are close to nearly $35 billion over the same time period. And finally, I think the uncertain global trade outlook with President Trump's policy priorities has pushed back Fed rate cut expectations. This has driven the USD higher, and this is weighing on both EM currencies as well as EM assets, especially risk assets.
Well, Vinay, I heard a few uncertainties and weakness. Could this morph into another bear cycle in India?
Yes, as investors would wonder if the current sell-off, which is like now in a correction zone, can be a larger bear market where can we get a 20% drop on the Nifty index. In our opinion, the probability of that is low. Now, we'd see three factors why we think the probability of that is low. First, macroeconomic fundamentals at the margin are improving. Now, historically, for bear markets to occur, you need significant economic slump. However, since the start of the year, we have seen our views that economic growth is likely to recover, as the stimulus provided in the budget and the commencement of RBI's policy easing cycle will put a flow on the cyclical GDP growth slowdown, which we have seen over the last few quarters. The second important factor is that equity fundamentals remain quite strong. Now, Q3 fiscal year 2025 earnings delivery, which is still going on, has been better than initial estimates. EPS growth over this 2025-27 period is likely to be close to 13%. Further, post the pullback, valuations also have become fairer, with the Nifty index trading close to 19 times on a 12-month forward PE basis, compared to its 10-year average of around 18.2x and much lower than its peak valuation of 23x. Lastly, major part of our pullback in our view is already priced in. Now, pullbacks, which is index falls of 10% and above, are very common in a large bull market in which we are right now. Looking at the past 10% pullbacks over the last 15-20 years, we have seen that corrections range from 10 to 15%. Given the current correction is close to 13%, we think of what major part of that pullback may be already behind us.
Now, that brings me to the last and most important question for investors. How can they navigate the uncertain market backdrop and the volatility?
So that's a great question. And in our view, diversification would be the key to navigate the volatility. And what we have highlighted in our outlook, the gap strategies which we would be cognizant of. So that means first, in foundation allocations, we still stay overweight equities. While it's very difficult to time the precise market bottoms, with the above environment as mentioned where growth is improving and earnings outlook, as well as a pullback, we would use this opportunity to add to equities, especially large cap equities, where we think the margin of safety is much greater in terms of both valuations and earnings. Second, don't forget about bonds. That's a key asset class when you're talking of diversification. In our view, bonds as an asset class provides not only stable income but also can act as a hedge against rising equity market volatility or if growth slows down further. Investors still have good opportunities to lock in attractive yields, especially in the medium and long maturity bonds and high quality corporate bonds. Lastly, I think multi-asset strategies and gold would be very key to navigate the volatility. Multi-asset strategies, which basically means dynamically managing your exposure to the major asset class, equity, debt, and commodities, would help improve your portfolio diversification as well as boost your risk-adjusted returns. Gold remains a very key portfolio hedge with strong central bank demand likely to be a major driver of performance.
And lastly, any risk that you see on the horizon?
So risks are there, given because of that we have seen the correction. What we would be looking at would be three risks predominantly. First, if we are likely to see a persistent weakness in domestic growth and earnings. Second is the uncertainty of the impact of President Trump's reciprocal tariffs. And third, how that would impact Indian assets through the currency channel.
Thanks a lot, Vinay, for taking our questions and being elaborate in your answers. At this point, I'll take a pause and thank you as always for listening.
Thanks, Ravi, for having me on the podcast.
Thank you, listeners. And if you want to get a copy of our Market Watch or the India Market Outlook February 2025, Staying the Course, you can always visit our website at www.sc.com/in and find it at the SC Invest section. You could also find it in the Standard Chartered Market View on the Go page in sc.com. Thanks very much.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.sc.com/in.